thank you to those of you who have asked questions within the group, and I'm going to go through them as I do most weeks now at a almost random way, because they cover a range of topics from car insurance through to investing, through to Brexit even. We had a question just at the last minute on Brexit. So do add your questions to the feed. Don't forget to join us on the podcast on a Sunday and Wednesday. I just want to plug that quickly, because if you don't listen to the podcast, we do a lot of good stuff on there. This week it's about how you can use the power of words to reframe your money situations and make it more likely, or increase your chances of achieving the goals that you want just through changing the use of particular words. And we also look at the dynamic of the 60%, 40% portfolios out there. So 60% equity versus with a 40% bond exposure, and why that's been tested to the limits and actually it hasn't performed as people would have hoped during the sell-off. So we touch upon that as well. I know that was a topic that people were interested in on a previous Facebook Live. But as ever, do ask questions while the show is going on. I'm hoping I'll be able to see the comments coming down the sideline, and then I'll answer them. Do just say hello if you want to, by the way. You don't have to just ask a question, just say hello where you are watching this from. So let's kick off with a question about the coronavirus help. Now, the first answer is go to the .gov.uk website. Now, they have links through to all the schemes that are on offer for people who are employed, self-employed, have businesses. And for self-employed people, there is a scheme out there that can help you, and there are certain criteria that you have to meet. So I'm going to rattle through these. You have to have submitted a self-assessment in the tax year of 2018 to 2019. You need to have traded in the tax year 2019 2020. You are trading when you apply, or would be if it wasn't for the coronavirus, and you intend to continue to trade in the 2020-21 tax year. You've lost trading profits, and your trading profits have to be no more than £50,000 or more than half of your total income. So I'm reading through these. I will post a link after this video to the correct place on the .gov.uk website where you can check the criteria and run through them. And importantly, your trading profits are based upon the tax year 2018-2019, or the average of 2016 to 2017, 2017 to 18, 2018 to 2019. The upshot is, if you go through to the link that I'm going to post after this in the comments of this video, you should be able to find out the help that you need. And based upon what you said, there is a chance that you should be entitled to something. Living at home with your parents isn't one of the criteria. The rule is you can pay into one ISA in the tax year, and you've got an allowance. So you've got a £20,000 allowance, which can be split between a cash ISA, stocks and shares ISA, and the different range of ISAs that are out there. And we've got a whole article on the website on this. I won't dwell on it. So the idea is you can't sit there and pay into multiple cash ISAs within a given year. There are some nuances to the rules, which I will post a link, as I say, to the article, which actually explain this in a little bit more detail, because there are some overlaps with things like lifetime ISAs and cash ISAs. But if you wanted to go around and just keep opening ISAs with everywhere that you want to, then you're eventually going to come unstuck. Just as an FYI, I do know people who've done that by accident in the past, who've had multiple stocks and shares ISAs in a given tax year. They put, say, £20,000 in the stocks and shares ISA with one provider and done something similar with another provider. And people are often intrigued what would happen. And what tends to happen, the HMRC will write to you and tell you that what you've done. And in the instances that I've seen with clients years ago, they never told them to actually undo it. So I'm not sure if that has changed now. You're not going to have people come crashing through your windows telling you you've oversubscribed on your ISAs, but they will give you a little sort of rap over the knuckles and tell you not to do it again. But there are more information about this on the Money to Masses website. The answer is it depends on your situation, whether you want to just have cash, if you want to invest for the future, if you're wanting to buy a house. So I can't answer which is best for you. You have to make that decision yourself. There are a number of videos we've done comparing stocks and shares ISAs to lifetime ISAs, but you need to read around the subject a little bit. I can't cover it all in this video, which is going to be best. So I'll put a link to some useful articles that people can go through and they can make the decision. But there are rules to each type of ISA. Now, the innovative finance ISA, that's more about your peer-to-peer lenders that are where you can invest within an ISA. I'm not the biggest fan in the world of them, only because, as far as I'm aware, it still remains that they're not covered by the Financial Services Compensation Scheme. So that would mean if they went under, then the money that you had in that innovative finance ISA would be at risk. Whereas if it was through you had a cash ISA with a bank that was regulated by the Financial Conduct Authority, then you would be, and licensed, you would be covered if they went bust. So I'm not so keen on them because people don't really understand the peer-to-peer element. There are more risks involved in it. So read around it. You have to be prepared for the risks that are involved in innovative finance ISAs. The idea of a pension pot, I think the younger you are when you start investing and looking at your pension, the better, as long as you can afford it. Now, that is one of the biggest regrets I have from when I first began to work, is not contributing to a pension. And auto-enrollment has started to fix some of that for people, where you are where employers and yourselves will pay into a pension, and it becomes a legal requirement for employers to do so unless you decide to opt out for some reason. Why you would do that, on the whole, I think it's a bad idea, given that effectively it's free money as long as you keep up your side of the bargain and pay in. Now, I just think as a rule of thumb, yes, you should try and invest, maybe pay into a pension, especially if you're getting contributions from your employer, which you almost certainly will do if you're employed. And it doesn't matter about the amount, it's about starting a pattern. It's starting behaviour where you pay in small amounts and then you start to grow it over time, so you can increase those contributions maybe a year later or a couple of months later. So there's always that ability to start to snowball. Once you start a habit, you don't miss that money, and then it becomes something that you continue to do. And actually the compound effect, whereby the growth on your investments and the growth on the growth starts to be quite powerful over time. When you're young, the biggest influencer on the size of your pension pot actually is how much you pay in. Because if you pay in a small amount, you can take all the risk you want in the world when it comes to a pension. But what will happen is, if you make a huge speculative investment and make a return on your money, if you've only paid £10 in, it's not going to make much of a difference. So the secret is to try and pay in as much as you can afford to, and then that your pension pot will grow. Then the magic of compounding will have a bigger and bigger impact, because that snowball starts to get bigger. And so at the other end of the scale, when your pension pot is that much bigger, then the return you make on that investment has a much bigger impact on the size of the pot, and ultimately on what your retirement income will be. Now, again, if you go to, I'll put a link in the notes of this video. There is a page on the .gov.uk website that details what is included and what isn't. And there is also a calculator that you can go through and answer the questions, and it will tell you what percentage or what part of your earnings are included. But the amount, just to rattle through it, that you should use when calculating 80% of employees' wages, this is guidance for employers, is the regular payments you're obliged to make. So they're regular wages you pay to employees, non-discretionary overtime, non-discretionary fees, non-discretionary commission payments, and piece rate payments. Now, you can't include the following when it comes to calculating wages, and these are things like any tips discretionary bonuses, discretionary commission payments, non-cash payments. There's a list of these things. So it's very much a rule-based system. So if you go through there, you'll be able to work out exactly what it is that your partner is and isn't entitled to on the 80% furlough scheme. Now, there are no guarantees when it comes to investing. The idea of investing is that you're going to take risk with the capital, so there's a risk of downside, so you're a risk of loss. With your bank, you're unlikely to lose money as long as the bank doesn't go bust, and even if it does, if it's covered by the Financial Services Compensation Scheme, then you will get your money back as long as it's below the threshold. Now, do you go into investing? You need to have a time frame that's of at least 5 years. You need to understand your attitude to risk, the tolerance of the losses that you can have, because if you're moving from cash straight into investing, then I think a lot of people, it becomes very unnerving for them when that money starts to tumble, like it would have done in the recent sell-off. Now, I see a lot of people or a lot of companies out there trying to acquire customers, and one way they do it, I'm talking about investment platforms, for example, is they will try and acquire people who've got lots of cash and then go, well, if they've got all this money, then we can sort of convince them, take them on a journey where they start investing. I'm always slightly uncomfortable with that. That's okay if people understand the risks involved. If you're just saying to somebody, look, you're not getting anything on your savings, hop over here, you could make 5% a year on average based upon historic research, where that hides the 10-20% drops you get, or the 10 or 20% rallies. So there is no cast iron guarantee. You would have to move up the scale of investments, so from cash to things like bonds, and that moves all the way up to equities, and within those categories there's lots of different investments. So you want to diversify your portfolio. The higher up the scale you go in terms of risk, the greater the return, the greater the potential losses. Index funds that you mentioned, they're cheap, they're passive investments, but with a lot of them there'll be 100% equity. So you've gone from cash to completely the other end of herring around the corners like a Formula One driver, so all the risks that involve. So you've gone from sort of fairly sedate, walking along the road, pretty safe, to the extreme levels. Now, there are issues with tracking funds because they will track the market. So when the market tumbles, you will tumble with them. Of course, when the market rallies, you'll do the same. So it's about diversifying. I do think that people should diversify across a range of assets and across a range of geographies. Now, if you go onto the Money to the Masses website and search investment calculators, there is a calculator on there that looks at the allocation of certain ETFs, but based upon where you can put in a sort of a risk level, your age. It uses the age guide. It's not a recommendation or advice. It just shows you how these portfolios can vary depending on the level of risk people are comfortable with. So do have a look at that. It gives you an idea of your level of risk that you would be taking, and perhaps go and look at some of the robo-advice companies out there. You don't have to open an account, but a lot of them you can go and do their questionnaires, their risk assessments, and they'll suggest portfolios for you and say that you're a low risk investor or medium or high. So it will allow you to understand yourself and the risk tolerances that you have. So it's a useful exercise. You don't have to pay for it. It's free. Take what you can while you can. Covered this, I think, before on previous videos, but you'll never get the bottom. It just won't happen. But the things that tend to improve from the current environment, or we'd want to see improve, to perhaps confirm that we've already had a bottom or that we're going to see one, I think the VIX, the VIX, so it's a measure of volatility basically in the S&P 500. It's called the Fear Index. That's its common name people use. That's up about towards 40. Historically, it's around about 20. If we get back down to those levels, that might allow the market to sustain a rally. At the moment, the market is caught between this scenario where it's rallied very strongly from the recent low, but now is kind of stuck just below a level of resistance. It needs to bash through it and then continue higher, or it will reject it and fall away. We also want to see bonds stabilising, which we have, but equally bonds are doing very well at the moment, and particularly things like treasuries, gold is as well, and these are rallying at the same time as equities, which is not completely unheard of, but it certainly is unusual, and it's almost like some havens are doing well while equities are generally doing well. Then which one is right? They can't both be right all of the time. Now there is a bit of a distortion in markets where central banks print money and keep interest rates low, monetary easing. We've had it for over 10 years. That does allow these kind of relationships to form. So normally you'll get haven assets probably moving in the opposite direction to stocks most of the time. So you probably would like to see some of those haven assets start to weaken and sell off a bit. That will show that people are believing this rally. And the other one I think is breadth, which is, if you think about it, if all of the stocks in an index, we talked about indexes earlier, so if you take an index that's got hundreds of stocks, so you could have the S&P 500, then you look at those stocks, what's happening is a smaller and smaller number of those stocks, which I'll come on to actually later. Someone asked a similar question about technology, are driving that index. They're forming a bigger and bigger part of it because they're rallying while everything else is falling. And what that does is that starts to distort that market, and it gives the perception of strength. But if everything else is falling and you're getting all the heavy lifting done by just a few names within that index, or fewer and fewer, it's almost like everybody's starting to fall away. And eventually that's not a sign of strength. That's just a sign of one person dragging it along. So think of it like a football team. It's a bit like if you have one player who is pulling that team along, the Steven Gerrard. I'll probably get absolutely slated from this by Liverpool fans. He can only do so much before the realities of who he's playing with the rest of his team start to catch up with them. And then, of course, what's happened? Liverpool have signed a load of fantastic players, spent a lot of money, but the strength and breadth of their squad means that they're now potentially winning lots of trophies. So it's the same thing in stock markets. Steven Gerrard can't do it all on his own. He didn't win a league title. I shouldn't laugh, but he didn't win a league title. It's the same with stock markets. We want to see that breadth improve. We haven't seen that, actually. It's rallied recently. It's improved, but it's actually pulled back a bit. So I talk about this on 80/20 Investor a lot and show people indicators. They're a bit too much to mention on these videos for ones to watch because you need a bit more time. And the answer is I would describe it as a very risky portfolio. I'm not sure the other assets will necessarily diversify as much as you would want, but it's your choice. It's as long as you appreciate the risks that are involved. I'm not here to tell you or give you advice about the portfolio you construct. The one thing I would say though, you have to realise that the level of risk, because you're basing a lot of the assumptions there about how well it's doing, how much it's held up, and technology stocks have been a very popular place for investment managers to go into. You'll never get moaned at by a client for buying Apple stocks, or shares in Amazon or things like that, regardless of what's going on or how well they're doing. Even if they tumbled, you go, well, it's Apple, it's Amazon, and of course the clients would be quite happy. So what you're getting is people narrowing into a very small number of stocks, which actually increases the level of risk that's involved in owning those, because what will happen at some point, almost inevitably, we will see the bubble almost pop on those, or we'll see a rotation out of those stocks into maybe some others, maybe other sectors that are unloved. Now, of course, with this environment that we've got now, it's the work from home era, we're getting things like Amazon do well. We're looking at things like Netflix doing pretty well. And the reason for that is because we're all being forced to use them. What will happen when we're not all forced to use them? And to give you an idea, technology stocks have done very well in this sell-off, and that's partly because of what people are having to stay at home and everything goes online. And the growth stocks, as I was mentioning, these tech ones, do tend to do quite well in low interest rate environments, and that's because the pot of gold, the future earnings that they're going to have after they've conquered the world, when you discount them back with interest rates when they're low, that makes them more valuable, because a lot of tech companies don't make a lot of money. Not the ones that I've mentioned, but other tech companies don't necessarily make a lot of money just yet. Amazon, Apple, Facebook, Microsoft, they currently make up more than 20% of the S&P 500, the US stock market. That's way more than any time since the 1990s. It's way more than the tech boom, the dot-com area that bust. I mean, those companies weren't involved in that period, but the top 5 stocks in the dot-com era, the dot-com bubble, they weren't actually necessarily tech stocks. They made a much smaller percentage of the overall market. So what we're seeing is the market is becoming quite stretched. The valuation of the market is now nearing levels that we had before the sell-off. So that's the price you're paying for the supposed earnings that are coming through, which are in themselves are unreliable, because we don't know what's going to happen with the coronavirus. And the other thing to point out is we're in earnings seasons, and these companies have yet to announce their earnings results for this period that includes the coronavirus. So hopefully they will be doing well, but there's the assumption that they will be obviously untouchable, and that can't be the case necessarily, especially not for Alphabet, which is Google, because don't forget they make a lot of money from marketing, people spending on adverts, so they're going to probably be hit. So the answer is, to your question, it's risky. I'm not necessarily saying it's a great portfolio, it's up to you, but you are essentially doing what a lot of fund managers are doing and a lot of people are doing. They're narrowing and narrowing into a smaller number of stocks, and at some point that rotates, that will more than likely come to an end. I don't know when, and it might go on for years where it doesn't, but be aware of the risks. The good news on pension payments is that they are covered in the furlough scheme. So pension contributions under the job retention scheme, they will pay the employer's pension contributions. Now, I'll include a link below this video that gives you a bit more information. But let's imagine you're auto-enrolled at work. Now, the employer's percentage will be covered, so that's the 3% but they will only be covered up to 80% of your wages, or the $2,500, whichever is lower. So that will be covered, but you need to pay in your share. So that's normally around about 4%. So you need to be paying in your pension contribution to get the employer's contribution and the government's tax relief. So if you can afford it, it's definitely worth still paying your pension contributions, because it will still keep your pension can still be topped up. The one thing to add to that, which is a caveat, if you are lucky enough to work for an employer who pays into your defined contribution pension at a rate that's higher than auto-enrollment, they don't necessarily have to do that now. So you are likely to see companies maybe not paying those additional contribution rates, which to a certain degree is understandable, and certainly the government scheme isn't going to pick up the slack on those pension contributions. I keep reading lots about house prices, and I have no idea, and the thing is, nobody has an idea what's going to happen with house prices. Now, that's not a get out, that is just the reality. This is something we've not seen before, people being in lockdown, a complete standstill almost on house purchases and house and sales. Some are still going through, but you can't go and view a property. That's not to say people aren't trying to. I know people in the industry keep telling me that they have people wanting to do viewings, which is obviously incredible, because they can't, so they're having to bat them back. But to give you an idea for people who perhaps pay to stick their finger in the air and make up figures about where house prices are going to be. The Centre for Economics and Business Research claimed that house prices are expected to drop 13% this year. Now, I wouldn't hang your hat on that, worry too much about it. Yes, there probably could be a pullback in prices. We're seeing it across all sorts of assets anyway. But when we get back to normal, we don't know quite what's going to happen to the market. The problem is there's lots of different indices about house prices. There's about the listed prices, asking prices, actual transactional prices. And that's the one that's key, I think. We don't actually have the transactional information, or as much as we would like, to make informed decisions or views on future house prices. So is it a good time for first-time buyers? Well, it's not, because you're not going to be able to go and buy a house. I just think you should be sticking to the plan that you had. Keep saving your money, and if your aim is to buy a house, then I don't think you should necessarily market time. It might put you in a better position when it comes to negotiation, which can only be good for you, but then you may have the offset of that when it comes to lending criteria for mortgage lenders, then that may vary as well. So it's kind of a double-edged sword. Basically, where you pay money to keep that no claims. And I looked around before this Facebook Live to see if there was any research that had been done on it. And interestingly, there was a piece of research that was published. I've forgotten actually to note who did it, to give them the credit. But if you search it, you will find it. And they looked at the extra cost of having the protection of your no claims discount on your policy, the additional amount you'll pay a year to do that, versus the extra you pay on claims. So if you had to make a claim, because obviously if you haven't got that discount, you're going to make a claim, and then the extra you're going to pay on your insurance when it comes to renewal. So they looked at all of that and put it in the mix, and they worked out that the average policy was £62 more expensive on an annual car insurance premium. Then when they looked at it, after the first year, if you made a claim after the first year, then you would be £155 better off if you had that no claims discount. Then what happens is each year that goes by, that starts to drop. And looking at it here, by year 3, you're only £31 better off. Ultimately, once you get to year 4, that seems to be the threshold by which you go over. Then if you hadn't made a claim, you start becoming better off by the fact that you don't pay more for your insurance. So I'm not saying after year 4 don't do it. I mean, it's a personal decision. So the longer your no claims discount, offsetting, the longer you have it, actually the insurers are slowly starting to win on that one. You look at the investment market, so there's different sectors. You'll have consumer discretionary spending, consumer staples. So they're things like the companies that produce cleaning products, household items, things that we always buy. Discretionary are the things that are maybe closed retailers. You have things like industrials, financials, which includes banks, real estate. It all varies along the different sectors. Now, things in healthcare and pharmaceuticals have done relatively well. They've held up better in the sell-off since the start of the year than other sectors. So if we look in America again, there's some good numbers you can see to see which sectors are doing well. Now, interestingly, it's not just because of the COVID-19 and oversimplifying it, just because it means that people we can make money out of potential cures. Some of this is down to the fact of the background, the macro background we're in, where we're seeing growth slowing, economic growth slowing, and inflation slowing. And if in those environments, the things that do well are consumer staples, so the things that people have to buy to live on, so food, that sort of stuff. Financials don't do very well because interest rates get cut. We've seen it, and that means that banks can't. It impacts their margins and their profitability. So again, and they're very exposed to the economic environment, so they're very cyclical. So banks don't do so well. So you'll see that in their share prices. And it doesn't help when the government and the Bank of England put pressure on you to not pay dividends. Industrials don't do very well. Factories, in this instance, have been closed. Energy stocks don't tend to do so well. This is all about being deflationary. All we've had is with the coronavirus, we've accelerated that. So we've got extreme versions of factories shutting, seen oil price plummet, which we saw this week in particular, because of less demand from industry, which therefore means energy stocks fall. We've just seen that really ramped up. So it's not down to coronavirus cures that why some of these sectors are doing well. It's actually because we've got an extreme version of a recession, almost veering into a depression scenario. Now, there is a company, if you want to see the pros and cons, really the dangers of just investing in companies that say they've got a coronavirus, not necessarily vaccine, but a treatment, then go and look at Gilead Services, Gilead Sciences, sorry, not services. Now they're a company, or Gilead are a company who said that there had been some evidence in hospitals in America that their use of one of their treatments had seemed to expedite the recovery of certain patients. So the idea being, this would be good news, because if we can help the most extreme people who have COVID-19 illness, we can speed up the recovery, cut it to days and get them out of the hospitals, then we reduce the death rate. This is good news. We don't have to worry so much about catching the coronavirus, etc., etc. And so the stock in that particular company rallied ridiculously. If I was just to look at it now, I think it rallied over, it rallied more than 12% in a space of a week. And then the news broke yesterday. China claimed that they had done some trials that showed there was no evidence that this drug in fact did any of the things that the hopeful people on Wall Street were talking about. And the World Health Organization accidentally published that on their website and pulled it down. And of course, you do that, someone's going to see it, and of course they did. And then the share price of that company fell 10% in a day. That was yesterday. So that shows you it's the hope and then the despair that you have with investing in companies like that. And that's a single stock. I know you could invest in a diversified fund, but it's very much veering into the world of speculation. So I wouldn't personally do it. I just think you're better off sticking to a process that you've had for a long time. You invest for the long term. Doing this sort of stuff is speculation. So I'm not sure it's something that people should be doing. I mean, it depends on if you're happy with the idea that you could be out in the market. Now, you can transfer a stocks and shares ISA to another provider, and what will often happen is you'll end up going into cash and then moving across, and then you'll have to buy the investments, and you could be out the market, and the market rallies, you'll lose out. If the market falls, you're better off. There are such things as in-specie transfers, where the idea being is you move from one provider and you remain in the funds, and they slowly get registered across to another provider, and so you remain in the market. The problem is if you want to change your investments during that period, which can take months, then you can't. So is it worth changing during this period? There are things that you can do. I often find when I've done in-specie transfers and things in the past that they end up just being cash transfers ultimately, despite you not wanting them to be. So you've got to be comfortable with the risk that's posed, the risk of missing out on the rally, but also, of course, on the other side, markets could move in your favour. And how much is the cost saving? If it's significant, then of course that's going to influence your decision. If not, you may be better off waiting it out until markets stabilise, and then you decide to make a transfer. And of course, it does depend on the stocks and shares ISA that you've got. It may be the reasons you're moving is because you basically don't have any choice of funds, and it's actually limiting what you do. So the reasons why, I mean, of course, if you've got a large portfolio and you don't know what to do, you then go and seek financial advice. They can weigh up the pros and cons for you. Now, I don't know exactly, but just logically, I don't see how Brexit can be anything but delayed, given the fact that we are so caught up in trying to solve the coronavirus issue. And given what the scientists have been saying, that we could be in this environment for another year, the idea of a vaccine being created in less than that time is almost fanciful. So I think we're going to have a lot of issues, especially with an economy that is going to slowly, it looks like, implode. Then I think it weakens our negotiation stance. It also, we're less motivated to do so, and I think Europe is going to be the same. So the government is saying that it's kind of full steam ahead, but they're also not really saying that. If you've watched any of the daily conferences, you'll see what happens is that the government backs away any Brexit questions and almost like, not now. And then they move on and then go back to asking the usual question of when's lockdown going to end, which is incredibly unhelpful. But Brexit, I think, is going to end up, I can't see how it isn't going to end up on the back burner, because what happened is when everybody was getting excited about the fact that well, not everybody, but the people who particularly wanted Brexit were excited earlier in the year that we were effectively leaving the European Union. The next phase there was a whole host of things we had to negotiate. So we were in this like limbo. Well, we're still in limbo, so we've still got to do those negotiations, but we'd have to do them at a very high concentrated speed if we're going to still hit the deadlines that have been previously set. So I'm not sure. I'd just like to say thanks to everybody who is in the group. They've done some, it's been great to see how people are keeping it very welcoming and friendly, and also politically neutral is another thing that I quite like to do. Somebody mentioned that in a previous post. So it's there for everybody. We don't want to try and politicise anything, and try and keep it very neutral. So if you've got any other questions, then don't be afraid to send them in, and I will see you again next week.